Trump just landed in Beijing for what officials describe as a diplomatic visit. But many analysts believe the real stakes may go far beyond diplomacy alone. At a time of rising debt, trade pressure, and growing competition over technology and AI, global investors are paying close attention to this meeting. What makes the visit even more interesting is the business interests surrounding it. Some of the world's biggest companies, including major technology and finance leaders, are closely watching the talks. And that raises a major question. Why has this meeting become so important to global markets and corporate America? This is bigger than politics alone. The United States and China remain deeply connected through trade, manufacturing, technology, and financial markets. And after years of tariffs and economic tension, many experts believe both sides now have strong reasons to reduce instability. In this video, we're going to break down the possible economic strategy behind the talks, why corporations and investors are watching so closely, and how debt, AI, trade, and financial power may all connect to the future relationship between the world's two largest economies. This is not about conspiracy theories or political sides. It's about incentives, leverage, and understanding how global power works. To understand why this meeting matters, you have to look at the people and companies connected to it. Reports surrounding the talks drew attention from some of the most powerful names in global business, including, and analysts also pointed to companies like Boeing, Qualcomm, Micron, Goldman Sachs, and Cargill, all of which have major financial interests connected to China. And the scale of these interests is difficult to ignore. Some of these firms are worth hundreds of billions of dollars. Others control trillions in global assets. Combined, they represent a huge part of the modern global economy. That is why many market analysts viewed this meeting as more than a routine diplomatic event. The level of business attention alone suggested that major economic issues were likely part of the conversation. But there is another pattern that stands out. Nearly every company connected to these talks depends heavily on access to China's market, manufacturing base, or supply chains, has faced growing pressure from export restrictions tied to advanced AI chips, still relies heavily on Chinese factories for production, continues competing for access to China's airline market, one of the largest in the world. These are not small business concerns. They are long-term strategic interests tied to technology, trade, and global influence. That is why many analysts believe this meeting may signal a new phase in U.S.-China economic relations. Because when many powerful companies focus on one geopolitical event at the same time, global markets usually assume the stakes are much larger than politics alone. The official story says this meeting is about reducing trade tensions and seeking peace between the United States and China. In simple terms, it is being presented as a normal diplomatic effort to calm down years of economic conflict and rebuild cooperation between the world's two biggest economies. But many analysts believe this explanation does not fully match the reality. First, there is a trust problem. The trade war did not start randomly. It began in 2018 and later became even stronger in 2025 with deeper economic pressure and expanded tariffs. So a key question is simple. If trust has been damaged for years, why would China suddenly treat this as a normal peace meeting now? Second, there is the issue of tariffs. The United States placed very high tariffs on Chinese goods, reaching around 145% in some cases. Many economists say this level is close to shutting down normal trade between two major economies. In that situation, you do not simply return to normal relations with a short diplomatic visit. The damage is long-term and structural. Third, there is the question of who was involved. If the goal was only peace and reduced tension, the expected approach would be to send diplomats or trade officials. But instead, major business leaders and billion-dollar companies were closely connected to the discussions. That raises a deeper question about what economic interests were really at stake. And this is where the story changes. According to geopolitical analysts, the key fact is this. The United States requested this meeting first, not China. That detail changes the entire picture. It suggests the U.S. may be under growing economic pressure and looking for stability after years of trade conflict. If that is true, then the idea of a simple peace visit becomes less convincing. Instead, it points to a situation where economic stress, global supply chains, and financial pressure are forcing both sides back into negotiation. That is why some experts believe the trade war may not have played out as expected. Instead of one clear winner, both sides may now be dealing with consequences that require urgent talks. To really understand this situation, we have to remove emotion and politics. Forget ideas like defending America or protecting democracy. In global economics, those are public messages. The real decisions are usually based on incentives, pressure, and national economic needs. So the real question is simple. What does each side actually want? From the American side, there are four main goals. First, access to China's large consumer market. China has over 1.4 billion people and a fast-growing middle class. For many U.S. companies, this is one of the most important markets in the world for long-term growth. Second, access to China's manufacturing system. Even with efforts to move supply chains, China still plays a central role in global production. Many industries still rely on Chinese factories because they are fast, large, and deeply connected to global trade networks. Third, there is the debt issue. The United States carries about $39 trillion in national debt. To keep this system stable, it depends on strong demand for government bonds. Foreign buyers and global investors help support this balance. Fourth, artificial intelligence and technology competition. The U.S. wants to stay ahead in AI development, while China is also moving quickly in the same direction. This creates strong pressure on both sides in the technology space. Now on the China side, the goals are also clear. First, access to advanced chips like NVIDIA products. These chips are important for AI development and modern computing systems. Second, energy security. China needs stable and affordable energy to support its economy and industry. Third, better access to global markets for exports and manufacturing. Fourth, predictability. China generally benefits more from stable trade conditions than from sudden policy changes or trade conflicts. When we look at this through game theory, the situation becomes clearer. This is not mainly about ideology or political messaging. It is about leverage and economic pressure. Both sides are trying to negotiate based on what the other side needs most. And in this type of situation, the side with more pressure points usually has stronger influence in the talks. Many analysts believe China may currently hold significant leverage because of its role in manufacturing, supply chains, and key industrial materials. This does not mean one side has fully won, but it does suggest the balance of influence is uneven, and that imbalance may shape the direction of all future discussions. To understand the deeper pressure behind this situation, we first need to look at the U.S. debt problem in simple terms. The United States has about $39 trillion in national debt. At around 5% interest, it now pays roughly $2 trillion every year just to service that debt. This creates a serious cycle. Because the cost is so high, the government often has to borrow more money just to pay previous loans. Many analysts see this as a long-term financial strain. So the key question becomes, how does the system keep running? Some experts point to a more complex financial structure involving money creation and digital assets. Here is the simplified mechanism. First, the Federal Reserve can create money and use it to buy U.S. Treasury bonds. This helps support government borrowing needs. Second, these Treasury assets can be connected to digital dollar systems known as stablecoins, such as USDC or similar products. These stablecoins are backed by real U.S. financial assets, including government debt. Third, this structure can allow global investors to gain indirect exposure to U.S. debt markets, even in countries with strict financial controls like China. Fourth, in theory, this creates a pathway where international savings can still flow into U.S. debt systems through digital financial platforms, instead of only direct government purchases. The result is a system where global money supports U.S. borrowing needs, while foreign investors gain access to dollar-based assets in a controlled way. However, this topic is not widely discussed in mainstream media. Some analysts believe this is because it shows how dependent global finance has become on complex and sensitive cross-border money flows. It also highlights how deeply connected the U.S. and China are in financial terms. Why does this matter? If major foreign buyers reduce their support for U.S. debt, even indirectly, it could put pressure on interest rates and financial stability. Borrowing costs could rise, and confidence in markets could weaken. This is why some experts believe these high-level meetings are not only about trade. They may also be about long-term financial stability and global capital flows. To understand the balance of power, we have to look at what each side can actually control in the real world. In global economics, power is not only about politics. It is about resources, supply chains, and financial pressure points. China has several strong leverage points. First is rare earth elements. China controls more than 80% of global rare earth mining and processing. These materials are needed for advanced weapons, AI chips, smartphones, and renewable energy systems. Without them, many modern industries cannot function. In a serious conflict, supply can be restricted very quickly. This gives China strong influence over technology and defense supply chains. Second is manufacturing strength. China still produces about 1/3 of global manufactured goods. Many major companies depend on it. Apple relies heavily on Chinese factories. Tesla also depends on Chinese production for key parts and assembly. Even with diversification efforts, replacing this system would take many years and very high costs. Third is financial pressure. China and related investors have been important buyers of U.S. government debt. If demand for U.S. debt drops, borrowing becomes more expensive. This can affect interest rates, housing markets, and even retirement savings. Because of this, China indirectly holds influence over global financial stability. Fourth is energy and geopolitical influence. China has strong trade links with major oil-producing regions, including partnerships that give it access to discounted or stable energy supplies. This adds another layer of influence in global markets. When we combine these factors, a pattern appears. China holds strong positions in materials, manufacturing, finance, and energy. These are not short-term advantages. They are built into the global system. Some analysts believe this explains why the United States faces more pressure in trade negotiations than expected. The original trade war strategy was meant to weaken China's position. But over time, China expanded its supply chains, strengthened its trade networks, and increased control over key resources. As a result, the pressure may have shifted back onto the United States. And this is why many experts believe Washington may now be in a position where it needs negotiation more than escalation. To understand what may come next, we need to look at what each side actually wants from these talks. In global negotiations, both sides come with demands, but the final outcome is usually shaped by who has more pressure and who can wait longer. From the American side, the main goals are clear. First, access to Chinese financial markets. This is important because it connects to global capital flows and dollar-based systems, including modern digital finance tools. Second, lower pressure on U.S. debt costs. With high interest payments, there is interest in keeping borrowing costs under control to protect the financial system. Third, continued access to semiconductors and advanced technology trade with China, even with restrictions in place. Fourth, maintaining access to parts of China's manufacturing base, since full separation would be very costly and slow. Fifth, influence over artificial intelligence development, where both countries are competing at a very high level. On the China side, the demands are also strong. First, wider access to advanced chips like NVIDIA products to support AI growth. Second, major reductions in tariffs and trade barriers. Third, stable energy access, especially oil supply security. Fourth, more cooperation in technology and AI development. Fifth, acceptance of China's growing regional role in Asia and nearby trade zones. Despite these differences, there is also a clear deal zone. Both sides want to avoid a major economic crisis. Both want stable trade instead of constant conflict. Both want to stay competitive in AI. And both understand that the other side still has real leverage. But there are also serious conflict points. Questions like debt exposure, tariffs, regional influence, and Taiwan remain extremely sensitive and difficult to solve. Because of this, many analysts believe any final outcome would likely be a compromise. Some predict a situation where both sides claim success publicly, but the results are uneven. China may secure more of its economic goals, while the United States focuses on stability and time. And in global economics, that type of agreement often reflects one thing: pressure on both sides to avoid escalation. To understand what may be happening today, many analysts look back at history. One of the most important moments was in 1972, when President Nixon visited China. At that time, the United States and China had been separated for more than 20 years. The U.S. did not officially recognize China and supported Taiwan instead. Relations were extremely hostile. Then suddenly, everything changed. Nixon's visit opened a new chapter in global politics and trade. Over time, China became deeply connected to the global economy, especially through manufacturing and exports to the United States. Many historians say this was mainly about Cold War strategy and countering the Soviet Union. But some analysts argue there was also a deeper economic reason. In 1971, the U.S. left the gold standard. This meant the dollar was no longer backed by gold. It became fully dependent on global trust and demand. After this change, the U.S. needed new ways to keep global demand for the dollar strong. Two major systems helped with this. First was the petrodollar system, where global oil trade was priced in U.S. dollars. Second was the rise of manufacturing trade with China, where global goods were also priced and settled in dollars. Together, these systems helped maintain global demand for the U.S. currency. Now some analysts see a similar pattern today. The U.S. national debt has reached about $39 trillion. At the same time, the global financial system is becoming more competitive, with other currencies like the yuan, euro, and rupee gaining more attention in trade discussions. In this context, some believe the United States may be looking for new ways to support long-term demand for the dollar system. One idea discussed by analysts is the growth of digital financial tools like stablecoins, which are tied to U.S. assets. From this view, China still plays a central role in global manufacturing and finance, just as it did in the past. And that is why some experts compare today's situation to the Nixon era, but in a modern form. The idea is simple. History may not repeat exactly, but it often follows similar patterns under different conditions. If this analysis is correct, then the effects of this meeting should not stay hidden for long. We should start to see clear signals in global trade, technology policy, and financial markets within the next few months. Within the first 30 days, we may see early signs of progress. This could include an announcement of a Phase 1 trade deal between the United States and China. There may also be reductions in tariffs, possibly moving from extremely high levels closer to the 30 to 50% range. In technology, companies could receive clearer permission to sell advanced chips into China again. We may also see public statements about cooperation in artificial intelligence, even if limited. At the same time, there could be new announcements about Chinese investment in U.S. industries like electric vehicles or semiconductor factories. Within 90 days, deeper financial changes may appear. Some analysts expect regulatory movement around digital financial systems tied to U.S. debt markets. This could include stablecoin frameworks linked to U.S. Treasury bonds. If that happens, indirect buying of U.S. debt by global investors could increase. During this phase, U.S. interest rates may begin to stabilize or slightly fall if demand for bonds improves. Politically, leaders may also start to frame the outcome as a win for both sides. Within 6 months, the effects could become more visible. Trade tensions may reduce by up to 50% in certain areas. Restrictions on U.S. companies operating in China could ease. New partnerships between American and Chinese tech firms may be announced, especially in AI and manufacturing. However, if tensions return, China may use its control over rare earth materials as a pressure tool again. The important point is this: these are testable signals. They are not hidden theories. They can be tracked in real time through news, markets, and policy changes. The larger implication is also serious. The direction of these talks may influence whether the US dollar remains the dominant global currency in the long term. If cooperation increases, it may stabilize the system. If it fails, global financial stress could rise. That is why analysts are watching every development closely.